Right, so I think we are live now.
Good to go.
Okay, good to go. Great. So, starting our next session, basically, welcoming you all again. My name is Varsha. I'm from Khaleej Time. Welcome back to New Age Finance and Accounting Summit. I hope all the attendees are having a good time attending all the session. Well, our next topic for today would be building supply chain financing and project financing framework. And our session moderator, Mr. Anish Mehta, I would like to welcome Mr. Anish Mehta. He would, just to give you a basic introduction for Mr. Anish, he is the chairman for ICAI Dubai chapter. Anish is an audit director in the professional firm in Dubai. He has a total of 20 years of experience in audit and assurance services, including 14 years in the Arabian Gulf. So welcome, Mr. Anish. I request you to please start the session. Thank you.
Thank you, Varsha. I would like to thank Khaleej Times and all its team for giving us an opportunity to have a good interactive discussions. And for that, first, I would like to invite all the eminent panelists, and it is my privilege to introduce each of them. The first panelist on the panel is Mr. Abdul Aziz Al Kati, who has more than 20 years of vast operational and financial experience in the field of corporate financial management, planning and analysis, leading corporate strategy, investor relations, corporate governance, and business plan development. Welcome, Mr. Abdul Aziz. The second panelist is Mr. Adnan Kaiser. He is the finance director of Total Solar. Currently, he is assigned to Shams Power, a flagship solar JV project in Abu Dhabi, and is a part of leadership group. He has years of accumulated experience in the power and water sector, experience working with multinational companies such as AES Power, ACWA Power, NG, and Total Solar. Welcome, Mr. Adnan.
Thank you, Anish.
The next panelist is Mr. Ahmed Al Shubar, who is the Vice President, Group Treasury and Strategy, Rawabi Holding Group. Ahmed's responsibility includes overseeing the group's treasury, corporate finance, bank relations, cash flow management, insurance, and strategy. He brings a wealth of banking experience in corporate banking and investment banking for over 12 years with reputable banks such as National Commercial Bank, Samba Financial Group, Bank Saudi Fransi, and Gulf International Bank, where he is served as Vice President in Investment Banking. Welcome, Mr. Ahmed Al Shubar.
Thank you very much.
And the last, but obviously not the least eminent panelist is Mr. Stanley Pulolikal, is the Regional Treasurer Commercial, Asia, Minat, and SSA General Electric, a treasury and banking professional with over 20 years of experience on both sides of the spectrum, providing expertise for all businesses needs on the treasury front across Asia, Minat, and SSA. In his current role at General Electric, he is based in UAE and is responsible for treasury-related tasks, enabling commercial wins and aiding the demand creation process. The tough markets do provide him the opportunity to collaborate with partners across the market and structure innovative solutions, especially on the trade front. Welcome, Mr. Stanley.
Thank you so much, Anish.
So now, since I've introduced all our eminent panelists, let's go to the task in hand about the discussion of the panel, which is building financial supply chain financing and project financing. We all have always heard and known that finance is always regarded as the lifeblood of a business enterprise. And particularly due to disruption because of COVID and post-COVID period, we can correlate it even more. And even in these times, the auditors are also focusing more on cash management, particularly relating to the going concern assumptions. So with this in mind, today we have two topics to discuss. One is on the supply chain financing and one on the project financing. So let's first take the supply chain financing. We all know that supply chain finance is one of the tools available for working capital optimization. Buyers and suppliers in a supply chain have competing financial interests. The buyer wants to pay as late as possible and the supplier wants to be paid as early as possible. Supply chain finance in recent time has emerged to bridge these conflicting interests, providing a range of financing and risk mitigation solutions designed to optimize working capital and liquidity in domestic and international supply chain. as per the recent study, supply chain finance has now surpassed traditional finance in market revenues, and we expect this trend to go even further. So let us hear from our experts and eminent panelists about their views on supply chain finance. It's relevant in the current scenario when everyone is trying to manage risk of going concern, manage their cash flows, which is key to smooth functioning of the organizations. In the later part, the other aspect which we'll cover in the panel discussion is the project financing. So quickly going through the first question, uh, which is to Steny, and then Mr. Al-Shubar and Mr. Abdul Aziz can add their experience to it. So Steny, do you think supply chain financing is a good alternative to bank lending, and particularly building risk management and resilience tool? And in your answer, you can include your personal case study as personal example as well.
Absolutely. Absolutely. Thank you so much, Anish, for the kind words and the broad introduction to the topic. Uh, at the onset, I think one important factor which we've all need to realize is one size will not fit all, right? So it's not that today, most of our banking colleagues are selling this product or putting this product up front as a tool which will alleviate all our concerns. Sadly, this is not that that tool which will eliminate or take away all our pains at one go. What we need to make sure is, does it really fit our business need? Now, like you explained, Anish, what does this tool eventually do? Supply chain finance helps us balance buyers asks as well as suppliers asks. However, for example, to go to your first point, is it an alternative to bank lending? Coming to this point, if you're looking at longer tenors, 1 year plus range of project financing, then this may not be the optimal tool. This primarily is a tool which will help you for your working capital requirements. And under this tool also, you've got multiple segments, right? You've got the conventional open account supply chain finance. You've got documentary credit as one of the tools. You've also got invoice-based borrowing, which adds debt onto your books. For this discussion, if we work with the example of using supply chain finance as an open account sort of a underlying transaction, this is a highly enabling tool to help us not record debt on our balance sheet on both sides. Now, what I must caveat this is, from an accounting perspective, one needs to be very careful on what documents you're actually signing to enable the usage of this tool. For example, I have encountered jurisdictions across the regions we support. Turkey, hypothetically, you sign the normal conventional supply chain arrangement. However, regulations there need you to also sign a loan agreement beyond the conventional supply chain agreement. And hence the accounting benefit, which you probably want, to avoid it sitting on your balance sheet, you may not get that for that jurisdiction. So it's critical to examine the underlying documents, look at the conventions of accounting from both IFRS and a US GAAP perspective. In my experience, the US GAAP norms around the disclosures you make, the documentation you sign, are a little more stricter compared to IFRS. So one needs to keep that in mind. Then if we move on from a risk management standpoint, as a supplier, when you have tons of receivables from different corporates like GE or other large corporates, where the buyer is asking you for longer payment terms, in this market and even beyond this market, you always want to do more business. You want cash through the doors faster, and also alleviate the risk of the account receivable on your books. Supply chain finance and the other terminology used here is reverse factoring, just enables that extremely well. You are able to take off the AR from your books. The cash which you receive is totally off, takes the AR off your books. You don't have any risk of commercial dispute or payments being held back. However, as I said earlier, there is a need for you to make sure that the underlying documentation which you are signing up with the banks presents the right picture of what you're expecting in the first place.
I think I would add to
So I
what
think you need to be extra
Andy.
cautious when documentation is concerned. And as you said, more cash means more business. Mr. Ahmed Al-Shubar, would you like to add your experiences to it?
Well, I think to add on what Stanley just highlighted, I think it's another tool that you use on your box of tricks that come handy during such times. Definitely supply chain financing and its different forms complements, I would say, is not a substitute for the normal working capital financing that you usually use with your banks. But it gives you another back pocket tool that you can actually use from time to time. As Stanley said as well, you have to be careful on documentation because it has been marketed widely as an off-balance sheet tool. And now even with the IFRS now, I think the chances of having a convincing documentation that can allow the auditor to accept the off-balance sheet treatment has to be done very well and tidy way, because it's becoming less relevant in this universe today. Nobody wants to see a lot of off-balance sheet lending. Everyone is getting stricter by the day to assure that it's done. However, one of the key things that especially small companies can benefit from, if I'm buying goods from larger companies, I can benefit or I'm selling to GE, for instance, or any other multilateral and multi-region corporates, and with a sizable scale, then I can benefit being, let's say, for example, an SME, a larger scale, or a small, medium corporate in any specific region from the credit of the other party, and stimulating a better structure, benefiting from the export funds and the export support agencies that are growing today to benefit from such structures. The discounting of suppliers' receivables that is being done widely now, but it takes two to tango at the end of the day. You need both parties to set and agree on documentation, accepting what the bank is proposing, understanding the key risk items. And it can be a good tool to have, especially during these times where you want your leverage on on-balance sheet basis to go low. So your capacity to borrow more can be there in case you need it. And such challenging times, you would need to have that capacity to add on leverage on your balance sheet, because nobody has a clear visibility on when is this gonna end. The new norm that we're living in, logistical challenges, what used to take. We are operating in the oil and gas sector and marine businesses, and we used to send our vessels to Dubai. It takes from the month to Dubai like 2 days. Okay, now it needs 21 days, including 16 days quarantine, mandatory quarantine period. So this is the new normal that we have to deal with. So this is an indirect impact that's cascaded to all areas of the industry, even those who are less impacted by the current pandemic as a direct impact. But there are side impacts and side effects that are hurting everyone.
Great.
I think sorry, just to add to this one bit, I think one very important factor of this whole tool is the resilience part of it, right? These times, the small suppliers can just be crushed under the bus if we don't, as large corporates, support them. And this tool, basis our credit, if you're able to give them better and cheaper source of financing, why not? We've got to partner with our ecosystem to be able to support one another. I think no better tool than that.
Great. And I think we have just run a poll and we have asked a question, have you dealt with institutional supply chain? And we got 88% in favor, which means it shows the popularity. Mr. Abdulaziz Alkati, can you add more to this about your experience?
Yes, thank you. And just to complement what panelists they mentioned earlier, I think we need to look into the supply chain a different perspective, which is what type of sector that we are dealing with, and this kind of supply chain factoring and impacting which sector. On the second scenario, we need to look into what is the macroeconomy situation that we are in. Globally, everyone was in a certain situation, the lenders, the banks, the corporates, and find with the pandemic situation and what we have seen complete change into the supply chain cycles, into the corporates balance sheets. Definitely, supply chain is one of the I could see it good practices those days, especially on the tough times, where it will balance the interest and the need between different components in the supply chain, between the vendors, the receivable part, managing the balance sheet more efficiently at this point of time. Take into consideration there is from industry to industry. If we look at, for example, telecom, where I'm coming from, that supply chain is going to be one of the major. It was implemented since 2010 almost, beginning of launching of supply chain activities in the telecom industry. And it benefits a lot of operators because the services that are provided and the nature of infrastructure and capex investments that required is massive. And this is continuous because we have seen so many technologies being adopted recently, which required another investment. Does the companies have the ability to invest more and more and keep investing? That's kind of limitation. But with the supply chain, definitely it's one of the options put in the table that manage the balance sheet of each companies, and as well moving forward to enable the companies to invest in the future as well. So
Great
this is
thought.
how I could see it from that perspective.
Yeah, so I think there is a consensus between panelists that this is the best tool to manage the balance sheet. So thank you for all the answers. Let us move to the another aspect of the panel discussion, which is the project financing. And we all know that there are many definitions of the project financing, but the most widely used definition is the raising of funds to finance an economically separable capital investment project in which the providers of the fund look primarily to the cash flow from the project as the source of funds to service their loans and provide the return of and a return on their equity invested in the projects. We have with Mr. Adnan, who deals day in, day out in the project financing. So let me ask him a question. Mr. Adnan, uh, is the project financing the perfect model when it comes to economic feasibility, structuring, sculpting, and the risk management techniques which are used in the project financing? Again, you can share your experiences.
No, thank you. Thank you very much, Anish. I think it's like we have got to a very good transition from corporate financing to project financing. We were earlier talking about the panelists were talking about the debt, the leverage on the balance sheet of the company, and this is kind of complete opposite to that, where
From
the
short term to long term, yeah.
push it forward to the SPV, to the project company, and they don't want to have that debt sitting on their balance sheet in the group balance sheets. So it's a classic tool, and so it's a very popular financing mode of raising debt and arranging the funds for capital projects. Public private partnerships are very popular these days in the Middle East, especially. A lot of projects are coming in, and all of these projects are fully funded by a syndicate of the lenders, and then there is the shareholders put in 20 to 30%, let's say, of the equity portion. So yes, it is indeed a very popular financing arrangement. For accountants, I understand, obviously, here a lot of most of our audience right now, they are from the accounting and finance background. So for chartered accountants particularly, it becomes more important, because the project financing is just not about arranging the funds and dealing with the banks. It also covers one of the significant aspect of it is the financial model. I mean, and the financial model, why it becomes so important, because the entire project financing is futuristic. the lenders are taking a risk in the future cash flows of a project which will become into construction, generate cash flows in future, and then arrange the debt service. So this financial model and maintaining the financial model, it has a lot of aspects from IFRS perspective, particularly that the chartered accountants and the accounting background people have a significant role to play in for not only for the cash projections, but from the earnings perspective. Because, I mean, we all know new IFRSs are coming day in and day out, and they have implications on your earnings, on your retained earnings. So that is very important to get that IFRS treatments accurately in the financial model, and have that, to avoid that cash trap in the form of dividends, and wipe off the retained earnings. So this is particularly important. Coming back to your second part of the question, I think you mentioned about the risk management techniques. So yes, I mean, definitely there are a lot of risks, as you can imagine, in comes with project financing, because it's all based on futuristic cash flows. So there is this construction risk, whether the project will be constructed in time, whether it will perform as envisaged in the base case model. Then there is the offtake risk, whether the revenues will be received in future as modeled. Then there are the operational risks. So all these risks are, one way or the other, we try to cover them in the project finance and project documents and the finance documents with certain caveats. Lenders are particularly very keen in imposing very strict covenants, reporting tools, so that they have full visibility on the project cash flows, because their interest is to obviously cover their debt and interest for the long term. I mean, they're taking a risk, imagine, for 20 years, 25 years. So they need to be protected. And
And I
again,
think particularly project finance loans are always extended on a non-recourse basis. So that
yeah,
makes it more unsecured. So therefore, you need to secure it by taking various safeguards.
absolutely. This is one significant difference with the corporate financing, is that this is non-recourse to shareholders. So the lenders can only take over on the project assets. They cannot go back to the shareholders. So it makes it even more stringent in terms of covenants that they need to protect themselves, and that protection is coming in the form of a lot of LCs, you can say, in the EPC contractor during the construction phase. There are LDs, liquidated damages mechanism, warranties are there, performance bonds are there. So these tools protect the lenders to a certain extent, as well as the shareholders. I mean, that is also one protection for the
Thank
shareholders.
Yeah. I
Thanks,
think
Adnan, for your thought. Let me ask Mr. Ahmed Al-Shubar if he would
Yeah.
like to add, because
Sure.
they are dealing in the long projects.
Yes. As Adnan just mentioned, now if we're talking about limited recourse type of financing for a future cash flow, you need to have comfort with the possibility of this project actually reaching the commercial operation. So, and the principal idea here is to have a strong sponsor, to have the company that undertakes or brought the idea to the lenders and to the finance community to be capable of delivering such project on timely manner with minimized cost overrun. We're not living in a perfect world. There was no project on this planet that has been done with no cost overrun. Even for the most powerful and the strongest companies on this planet, there is always this element, because we're talking about the future. Cash flows and forecasts are, at the end of the day, guesstimates, a scientific feeling of how things should look like. But we all know that they are not sacred, they keep changing. So the key principal idea here, and I would maybe differentiate and explaining it from what you, Anish, and Adnan mentioned on non-recourse to the more appropriate way, which is limited recourse, because there are always completion guarantees, there are always indirect. And today, and even there is a precedent in the United States where actually banks, without even having the legal documentation of recourse, went back after the shareholders and founders of the project and claimed their money and got it. Because the principle of this whole concept is built on the reputation and the ability and capability of the sponsor company. And there are similarities to the project finance, between the project finance and the supply chain financing. Supply chain financing, you have clarity that of a transaction that's happening now. In the project finance, there is an offtake agreement, there is a feedstock agreement, especially in power and refining and petrochem related projects. You have an off-taker, you have a feedstock provider, there are long-term agreements that are there for 20 years. But you know for a fact that 2-3 years down the road after completion, everything will be refinanced again for another period of 15 years. And nobody stays for this 15, 20 years. So there is a commercial update that's happening always. There is a repeated trade finance concept, a commercial transaction between supply and demand, that's been renegotiated every now and then because we're not in a static world. World is dynamic, and hence this concept. But worse get to worse, there is a minimum guaranteed level of economic activity that's capable of repaying that debt on that period of time. So it is meant to be tight in terms of risk management and making sure that the project company or the project itself does not have much of liberty to go and invest and go and spend money or pay dividends. No. You pay your lenders, you reach to a level where you are no longer a 50 times leveraged entity. You normalize, you look like a normal corporate, then you can refinance and get rid of all those covenants and restrictions and negative obligations.
Okay. Quickly going to Mr. Abdul Aziz Al-Kati, you would like to add something to this?
See, it cannot be, the colleagues, the panelists, they cover it very well from that perspective. Maybe if I wanted to add, it's about the risk management, actually, part of the project and the supply chain related. Today, there was so many techniques in risk management. And as we know, the project finance transactions consist of combination of 5 different related steps or interrelated steps like identification and the assessment, as well as reduction and the spreading, as well as the hedging and finally the insurance. So if we look at today, the risk management techniques and tools exist today. How it was relevant before the pandemic situation? Is there any kind of risk management tools that can predict what happens today and as well can predict what's going to happen the 6-8 months down the road? We have seen lockdowns and opening and again lockdowns. We have seen different parts of the world in different regions. So the risk management associated with different finance, let's say techniques or approaches is today you need to evolve and will keep evolving over the time. And that's maybe where it needs to be embedded as well in the cost and the alternatives of financings.
Yeah, just
thank you, sir.
Add, Anish, very quickly to what Abdulaziz mentioned. In the current terms of pandemic, yes, that is one thing in the risk management, particularly when it comes to the agreements, the power purchase agreements, and this pandemic term is now being discussed to be included in the agreements, because we had force majeure claims, but they never specifically mentioned that it was not envisaged. So this is being a discussion going on with the off-takers to put up this COVID-related claims back to the off-takers to protect the interest of the shareholders. So this is.
I'm sure now the new definition of pandemic will come up very soon.
Yeah.
So since we are short of time, I just would like to ask Varsha if there are any questions for the panelists.
Yes, Anish, there are quite a lot of questions.
Can we just take one?
Yeah, sure. So Mr. Kira is asking how to choose a low-cost financing option for short-term as well as long-term financing?
I think it starts with Stanley's first statement: one size doesn't fit all.
No, precisely. I think if I can take a stab at this one, I think this question by itself can be one whole session. But in a nutshell, there is a need for you to evaluate what is your your cost of capital in the first place, and then arrive at a best fit solution. And also then who's going to pick up this cost of financing, right? If your supplier, if you're doing a supply chain sort of a financing, if you're passing the cost over to the supplier, does cost really matter? So there is a need for you to work collaboratively with your banking partners, with your entire project management team, to arrive at the right cost mix to see what works best.
Great. So very quickly, last thing, do you think, what are the technologies you use in your organization? It's kind of rapid fire question.
Yeah, I think the key thing here, I think we've been investing in cloud computing for quite some time, even before the pandemic. So when we were told that tomorrow is when the curfew starts and lockdown starts, it was a click of a button. We just need to do the testing, and we're fully working from home. We've had Fusion as an ARB. We have, that's maybe a marketing thing, but we've been adopting cloud ARB. We have been, the platforms are there. So investing in business continuity is not like investing in the entire platform and the ecosystem that you operate in. And I think one of the key things is you need to invest during the times that you don't need that investment, especially in mission critical items, technology, business continuity, remote accessibility. People were telling us, why you're investing all that money. Today you have nice servers, you have nice physical data rooms. Why do you need that investment? And it just became handy. We were lucky. We're not the smartest people in the room. We just got convinced, and we went for it 2 years ago. And today it became very handy for us. So today we realized that we might even need to lease out our office building to somebody else, to a hotel or somebody else who needs the space, because we don't need all that space anymore. So the whole business is changing, the business models are changing, and this is all thanks to technology and reliability of the infrastructure in the country. We have been working with partners like STC here since we're having them. It's good to have a strong telecom infrastructure in the country, and not only STC, all providers have been working hard and assuring that we all stay connected, and thanks to them, we made it.
All right, thank you so much.
Thanks to all of you.
It was an amazing panel discussion. Thank you, Anish. Thank you, gentlemen. It was an honor having all of you all, speaking so much about this topic. Well, I would request all the attendees, the next session is already started. So I would request you all to please join in the next session. And thank you, everyone. Thank you, all the attendees, for attending the session. Thank you.
Thank you.
Thank you so much.
Thank you.
Pleasure.
Thank you.
My pleasure. Thank you.